Hello, everyone. Welcome to Demand Supply Trading Practical Session number 9 for the year 2025. Myself, Surjit Kakkar, and today is Sunday, 2nd of March, 2025. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you regarding the schedule of these sessions when these sessions are happening. Plus, if we have content or videos coming up related to demand and supply, we also share it on that channel. And yes, if we also have some promotions coming up, we again posted on those promotions on this channel. So yes, to be connected, if you wish to join this Telegram channel, you can do that by scanning the QR code which is on your screen. Otherwise, you can also find the direct link in the description, and by clicking on that link, you'll be able to join this channel. Plus, once you visit our website, which is surjitkakkar.com, or you can also use the short URL which is sk.coach. And once you're on our website, what you can also do is on any of the pages, you can just scroll down to the footer. And at the footer, you can see you have this option, join Telegram channel. You can click on join now and you can join this Telegram channel. So these are a few different ways how you can join this Telegram channel. Now, talking about today's session is a practical application of demand supply methodology. So our demand supply course, which used to be a paid course, is now available as a 100% free course. And when you go through the course, you learn the methodology theoretically, what is demand supply, how it needs to be applied. But unless and until we see some practical examples, at times we are not able to understand or apply the methodology very easily. So that is why I conduct these practical sessions, which is once a week, where we take some examples, and to those examples we apply the complete methodology so that we can understand how to very mechanically and rule-based plan trades. Now, the best part about these sessions is that we are not looking into something which has already happened in the past, because like I always say, that's a piece of cake. Whatever has already played out, you can apply any indicator, any oscillator, and you can find a number of reasons why you would have participated. But the real fun is when you're doing your analysis in advance and you're identifying these areas of demand and supply in advance, that these are the areas where I would like to be a buyer or a seller. And eventually when prices, they revisit these areas of demand and supply, that is the time these examples that I'm sharing with you, they get triggered. And just because I'm sharing these examples in advance does not mean that I share them with you and then we forget about it. Whatever I share with you, eventually when they get triggered, we also review them, so you're able to see the before as well as the after, and that helps building up confidence in the methodology. And the fact is, unless and until you have confidence in any of the methodologies, you would not be willing to learn it, right? So the sessions in a way helps you build that confidence in the methodology so that you can start learning it, and then you can start applying it to your own trades. All right, now before we move ahead with the practical session, there are some prerequisites which are required for this session. And if you have gone through those prerequisite steps, these sessions will be much easier on you. So let's understand what those prerequisites are. So the very first one is the Trading Essentials course. Now, the reason it says optional is because someone who already has a very good trading experience, have been trading for a number of months or years, they can definitely skip it. Though I would not recommend it, I would still suggest to go through the Trading Essentials course first. And this is also a 100% free course. Now, how can you access the Trading Essentials course? How can you go through it? Very simple. Once you are on our website, under the service tab, you will be able to find our courses, right? So just click on courses. And here the very first one is Trading Essentials. Click on Get Started, and then you can see the courses available in both languages, English as well as in Hindi. So whatever language you're comfortable with, just click on that. It will take you to the watch list of, sorry, not the watch list, right? Say again, I'm going back to trading. It will take you to the playlist of these lessons, and the lessons are designed for you in a very systematic way. Lesson 1, lesson 2, lesson 3. Go through these lessons, and once you're done with the lessons, you're basically done with the Trading Essentials course. No registration is required, so it's just one click and you have access to the course content. Now, once you are done with the Trading Essentials course, the next one is your demand supply trading course, wherein you will be learning demand supply methodology theoretically, what it is and how it needs to be applied. Now, again, on this page, once you're on services, once you're on our website, click on services, then the courses. So on the courses page, the second option is your demand supply trading course. And once you click on it, it will again take you to the course page where you have the course available in both the languages, English as well as in Hindi. So just like I said before, once you click on these buttons, it will take you to the playlist where the lessons are in a very systematic way laid out for you. Lesson 1, lesson 2, lesson 3. So I guess it's about 15 lessons. And once you go through all the 15 lessons, you have basically covered the complete demand supply methodology. Like I already said, going through the course will cover the methodology theoretically. So what I do is I also do practical sessions. That is what we are doing today. But it's not these live practical sessions. You also have access to the recordings of all the past sessions. So if you want to go through more number of practical sessions, you can click on YouTube live sessions, which are again available both in English as well as in Hindi. So currently we have an archive which is over 1 year of recordings. So you can go through a number of sessions, because the more number of examples you'll see, the better you'll start having the understanding of the methodology, how to apply it. So that's your demand supply trading course. Now, when you're going through these practical sessions, you will see that I utilize 2 documents, which is the rule book and the flow chart, to make the approach very mechanical and very rule based. And how can you access these documents? The direct links are definitely available in the description. Otherwise, under services, you also have the option for downloads. And once you go to downloads, the very first one is the rule book. The second one is flow chart. So you can click on download and you can download these documents. And again, in today's session, you will see how we use these documents for planning our trades. So this is the very first one, which we call as the rule book. And that's the second one, which is basically the trade plan. So yes, that covers basically all the prerequisites. And before we get started with our today analysis, we have one trade which was getting carried forward for us. So we'll definitely review it. And we also have one which got triggered during the week. So let's review these. And after doing the review, then we'll start with our analysis for today's session. So the very first one is this particular example, which was session number 3. So we did session number 3 on the 19th of January. And then the prices came back into the zone on the 18th of Feb. We got a move which was about 2:1. That is where we talked about that now we can make it as a break-even trade. So yes, we would have made it as a break-even trade, but eventually the prices came down and you would have got an exit as a break-even trade. Though we went pretty deep into the zone, the distal line has been violated, though wherever our stop loss would have been, it is still not breached. But yes, it will be a break-even trade for us based on our rules. After a 2:1 bounce, we only got an opportunity to have a break-even exit on this one. So that basically covers the one which was getting carried forward for us. Now we also have another one which got triggered. So let's review that one as well. Now this is from the last session, which was session number 8. So you can see session number 8, we planned the zone, and you can see prices came into the zone on the last day of the week, which is Friday. And when the prices came into the zone, let's see how was the reward to risk ratio. So let's verify that. So you can see when the prices they came into the zone, our opposing fresh zone is somewhere around here, which is only showing us a reward to risk ratio that is 1:1. But the advantage here is that we were planning this trade at the best location, because you can see if I go to the higher time frame, this is also a monthly zone. And whenever you're planning your trades at the best location, if you don't have a good reward to risk ratio from the lower time frame, you can definitely check the intermediate time frame. And on the intermediate time frame, you can see I have a reward to risk ratio which is probably about, maybe if this is 4, 5, around 6:1. So reward to risk ratio is not a challenge, which definitely qualifies this trade as a valid trade for us. Yes, even though on the lower time frame the reward to risk ratio was spoiled, but if I go to the rule book, you will see we have this rule laid out for us, which is for the targets, TAR GET, right? So you can see a rule for the target is that we always use the opposing fresh zone on the lower time frame using wick-to-wick method. But when you're trading at the best locations, you can even use your intermediate time frame, right? So since the lower time frame is not showing us a very good RR, we definitely could check the intermediate, since we were planning the trade at the best location, which is showing us about a 6:1. So this will remain as an open trade for us unless and until we get an exit on this. So we'll track it for the next few sessions and see how this one plays out. So that basically takes care of the examples that were getting carried forward and the one which got triggered for us during this week. And now we can start with our analysis for today's session. So just give me a second. Let me bring up the one which we will be analyzing today. Perfect. So let's get started. So our step number one, whenever we start planning trade, the first thing we need to do is define our trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade, and that is from the time we enter the trade to the time we exit the trade. Now, why are we, in fact, what do we mean by exit? Exit does not mean just the target. Exit can definitely be the target, but it can also be break even. It can also be the trailing stop loss. It can also be the stop loss, any kind of exit. So now the question is, why am I starting with the trade purpose as my very first step? And the reason we are doing this is because when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that there are a number of time frames available. So what are these a number of time frames? Which time frame should I be using for my analysis? And to help us decide what time frames we should be using, we follow this as our step number one, because again, we don't want to select our time frames randomly. We again want to go in a very logical way. And that logical approach is that the longer I want to be in a trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, one thing which I'll definitely add here is that if you're trading markets which are not 24-hour markets, like we are taking examples from the NSE, so I'm pretty sure you would have experienced whenever the market opens, some symbols, they'll gap up, some of them will gap down. And having a gap up, gap down, what can happen is if it gaps in your favor, yes, you can get profit, which is bigger than what you were expecting. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we are holding a position overnight has that added gap has that added gap risk, which we would like to avoid early on. And this is why my recommendation to you would be that your hourly dailies should be done strictly as intraday trade, because we don't want to take that unnecessary overnight gap risk by keeping them as overnight trades. For weekly monthlies, anyhow, we are not expecting to get the exit the same day. So here we have no choice. We'll have to keep these positions as overnight positions. But that does not mean we cannot have gap against us for weekly monthlies. It can still happen. But since we are leaning against some bigger time frames, the probability definitely reduces. But with time, with experience, if you want to include daily incomes into overnight trades, that can also be done. It's just that as a risk management rule, initially hourly dailies intraday, weekly monthlies overnight. So step number one was to define my trade purpose. Let's assume I opted, I want to plan monthly income trades. Now, once I've selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if I go to page number 28 on the rule book, we start with the topic, which is multiple time frame analysis, because demand supply is not based on single time frame. Demand supply methodology utilizes multiple time frame analysis. So what are the multiple time frames that we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes, like fine-tuning the zone, different kind of entries, like your type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question is that for each purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Now, mind it, this table, which is on page number 31, is specifically for the NSE market, because this market is only open for 6 hours and 15 minutes. If you're trading markets which are open for longer durations, like your commodities, forex, cryptocurrencies, then you can refer to the table, which is on page number 32. But since I'll be taking examples from the NSE, I'll be following this table. And as I've opted, I want to plan monthly income trades. My time frames will be monthly, weekly, daily, 60. Monthly is the higher time frame, which is used for curve analysis. Weekly is the intermediate used for trend analysis. Lower time frame will be daily. That is where we get our SETS from. SETS stands for stop loss entry target and size. And in case we need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine tuning the zone, type 2 type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. So as soon as I'm done with my step number 1, I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. Now, challenge number 1 is taken care. The next challenge comes is, yes, I do know my time frames, but if I take the example of NSE itself, we have over 2,000 symbols listed on the NSE exchange. So humanly not possible that I sit and analyze 2,000 companies every day. So what we need to do now is we need to have a process in place for helping us select a smaller list of symbols, because if you have a smaller list, you can do your analysis almost every other day. But going through 2,000 symbols every day is not possible. So how do we do this? For this, we use certain computer programs which are called as scanners or screeners. Now, when it comes to scanner screeners, which are specifically based on demand supply methodology, we do have 2 custom built tools for you. One is called as the demand supply zone alert, and the other one is the demand supply zone screener. Now, once you click on this, it will take you to our product page where the walkthrough videos are available. And in fact, I'll also show you how you can do it from our website. So once you're on our website, again, under services, you have trading view indicators. And here you can see you have the alerts, you have the screeners. So you can click on them. On the product page, the walkthrough videos are available. That will help you understand what these are. And again, these are not the only scanner screeners which are available in the market. If you do a Google search, you'll be able to find a number of scanners and number of screeners. But mind it, majority of them will be based on either conventional technical analysis or fundamental analysis. And since there was nothing available based on demand and supply, these are 2 of our custom built tools purely based on demand supply methodology. Now, always remember, irrespective what scanner or screener you're using, whatever results you get from these scanners, you can never blindly buy or sell these stocks or symbols, because scanner screeners, they don't tell you what you need to buy or sell. They only help you shortlist a smaller list of symbols. Once you have that list, you will have to analyze them one by one individually and check which one matches with your trade plan. The one which matches with your trade plan can be an opportunity for you. The one which doesn't match with your trade plan, you can simply skip it. And the process can be as simple as, let's say I can say I only want to analyze my Nifty 50 symbols every day. So you can see instead of now having a list of 2,000 symbols, I only have a list of 50 symbols, which I'll be going through. So choice is yours, how you want to get that small list. I just showed you 2 tools which are purely based on demand supply. And again, like I said, if you do a Google search, you'll be able to find a number of scanner screeners. You can use whichever you want, because like already said, they don't tell you what you need to buy or sell. They only help you get a smaller list. So once you have a smaller list, the next step is to analyze them one by one. And let's assume the very first in this list was ABC. So what we need to do now is we need to go to the lower time frame. So the question is, what is my lower time frame? We got the answer from our step number 1 when I selected or made my choice that I want to do monthly income trade. So as a monthly income trader, my lower time frame is daily. So here, lower time frame would imply the daily chart. And on the daily chart, I need to identify zone. And by zone, we mean any of these 4 structures: drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. Now, the next best thing is that our demand supply zone indicator, we are now providing it as a 100% free 7-day trial. That's a one-time trial. And if you've still not tried our indicator, you can do that for free. Now, how can you do that? Very simple. Again, once you're on our website, under services, you'll be able to find trading view indicators. Once you click on it, you'll be on this page. And the very first one is the zone indicator. Click on it. And on the left, you can see you have a 7 days free trial. Click on it. It will take you to our page where you can, provide your information, which is your email address, your TradingView username, and your full name. Only 3 things are required. Now, very, very important, do ensure you're providing the correct TradingView username, because if you provide an incorrect TradingView username, it will not get activated for you. Now, if you already have a TradingView account, you can simply click here, visit your profile, identify your TradingView username, and you can input it here. But if you don't have a TradingView account, you can click here and you can sign up for a 100% free TradingView account. After opening a free TradingView account, you can again provide your TradingView user ID. And once you have filled this form, the indicator will get activated for you within 24 hours. And once it is activated, you'll receive a notification on TradingView that it has been activated. And then you can use it for 7 days. So since everyone can now at least try the indicator for 7 days for free. Therefore, all the analysis we'll be doing will be based on the indicator, which makes the process easier, faster, and mechanical for us. And since I've already applied the indicator to the chart, you can see the indicator is telling me that we do have a demand area, which is this rally-based rally structure. So I'll mark this rally-based rally. So my step number 3, which was to identify the zone, is already done by the indicator automatically for me. So yes, our step, just give me a second. Right, our step 3 was to identify zone. Do we have a zone available? The answer is yes, we do have a zone available. Now, once you have identified the zone on the chart, doesn't mean you can blindly trade it. The next step is to qualify it, for which we follow a 2-step process. In step 1, we'll qualify based on certain conditions. And in step 2, we'll qualify based on the booster scoring. So the very first thing we'll check is that the zone I have identified, can it qualify as a case of level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different zone. And how do we verify that? It's a very simple concept. If you have an intermediate time frame zone and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So the first thing we understand from here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which is called as a coinciding level. So you need to have a coinciding level. So if you have a coinciding level, we might have a case of level on top of level, but if you don't have a coinciding level, it cannot be a case of level on top of level. Now, the best part about the indicator is you can define your higher time frame, intermediate, and refining, so that whenever you're switching to these time frames, the applicable settings, they get applied automatically. So if I go to my intermediate time frame, in this case, which is weekly, you can see wherever I have my lower time frame zone, I don't have any intermediate time frame zone. So in a way, it is not a coinciding level. And if it is not a coinciding level, it cannot be a case of level on top of level. So level on top of level not applicable. This zone is not because of a gap. Therefore, I'll not be applying the gap rules as well. Pivot nor authenticity not applicable because it's a rally-based rally structure. And unstable equilibrium is also not applicable. So looking at all these conditions, none of these conditions were applicable. And if these conditions are not getting applied, they cannot disqualify the zone, right? So after applying the applicable conditions, applicable rules, no, none of the rules were applicable. So does that make this zone as a qualified zone? The answer is yes, because if they are not getting applied, they cannot disqualify the zone, right? Only if they are getting applied, then 2 possibilities, either qualified or disqualified. But since these conditions are not applicable, the zone cannot be disqualified due to any of these conditions. So now that we know we have a qualified zone, the next step will be its quality and the probability boosters. So let's get started with that. Give me a second. So the first one is freshness, and we can see the zone is definitely fresh, gets a score of 3. Talking about strength, we do have an explosive move, gets a score of 2. Time at the zone, we only have 2 candles in the basing, gets a score of 2 again. And the last one is reward to risk ratio, which we will take as an assumption because nobody knows how the arrival will be. And based on the arrival, the reward to risk ratio can change. Next is the location. So if I go to the higher time frame, you can see we do have a monthly zone here. And we are planning our trade inside of a monthly zone, which definitely makes it as the best location. So since we are planning at the best location, we can give it a score of, a score of 2. Now at best location, trend becomes irrelevant. So it doesn't matter whether it is an uptrend, downtrend, or sideways, it will be a score of 1 for trend. Now talking about move from the zone, let's check. Fact is, we can visually see we already have a move which is more than 4:1. Probably we have a move which is maybe 17:1 or 18:1 before the prices have started coming back into the zone. So this gets a score of 2. It is not a case of level on top of level. It is not even coinciding. And the fact is we can even skip trap. Why we can skip it? Because you can see it doesn't matter whether it gets 0 or 1, it will remain as a type 1 trade for us. But yes, if I want to double check that, I can take a horizontal line wherever the proximal is. and I'll start pushing it up, visually trying to identify an area where the prices have been bouncing over and over again. So if I look at this area, can you see it has acted like resistance, somewhat support, acted like resistance, but nothing really nice in the past. But if I go a little higher, probably this area might look even better. So you can see this area in the past has beautifully acted like resistance, has beautifully acted like support, has acted like resistance. So we do have an area of support and resistance, and we are sitting right below it. So what is going to happen? People who believe in support resistance, they would have already started buying with their stop losses below this, which will be sell orders. And because of this breakout, people who believe in breakout will also start selling. So by the time we are entering this area of demand, there can be a lot of selling coming in. And these people are making two novice mistakes. Mistake number one, selling after a decline in price. Mistake number two, selling in an area where the chart has proven to us that back in history, demand exceeded supply, which could be the only reason for prices to move up. So yes, it can work like a trap, for which I'll give it a score of 1. So if you look at the overall scoring, we have a score of 10 out of 10 with the assumption of reward to risk ratio, which makes it as a high quality zone, and 6 out of 8, which makes it as a high probability zone. And high quality, high probability can be done as a type 1 trade. Now, one thing which I would also like to add here is, can you see, I can also see that there is a small gap, which is still an open gap. Now, when I see something like this, and I have talked about this many times, that I am a little conservative trader. So because I can see this is my monthly zone, and what I'll do is I'll just draw it with a different color. And like I said, since I can see that this is complete a monthly area and I have an open gap, so if I want to plan my trade, ideally I would like to be a little safe, which is where I would like to have my stop loss below the distal line of the higher time frame, and also having my entry at the fill of the gap. That is something I would like to modify. Now, again, this is something which comes from my experience, but that doesn't mean that this will be an invalid setup for us. This is still a valid setup. It's just that, like I always say, different people, different personality styles. So I'm just showing you that if I see few things on the chart, how I make my modifications. And one modification which I would definitely like to do is, instead of this, I would like to lean against this, because we'll have a stop loss at a better location. Plus, it also takes care of the gap, because prices, they generally tend to fill the gap. But yes, what might happen is we might get a bounce from this, which can give you maybe your target, and then it starts going to the lower one. And then again, you might get a bounce, right? But yes, the upper one is definitely valid. It's just a small little variation which I would like to do for my personal trade. So that is why I also wanted to touch upon it, because it's not just what I have in the rule book. I want to go with that. I also like to show you where I would have made some modifications and what would have been the logic behind that. But yes, it has its own pros and cons, and the downside is we might miss a trade, right? Prices might react from here and I might not get this opportunity, but I would still be more comfortable trading the lower zone based on my experience. All right, so that basically takes care of the boosters. So after applying the boosters, we got to know this is going to be a type 1 trade for us. Now next is position size calculation, because no matter how high the quality or the probability, any trade can be a stopped out trade. And that is why we need to be ready for the worst case scenario, so that in case it doesn't go in our favor, it goes against us, I should not lose more than what my trade plan allows me to lose. So that is where you'll be doing your position size calculation. Now, whenever the prices are back, you'll have to re-verify, because the markets are not static, markets are dynamic. Conditions are changing almost every other second. So before entering a trade, we need to verify, does it still qualify based on my trade plan? If the answer is yes, you place your order based on the entry type, in this case a type 1 trade. And the last step is your trade management, where step 1 is 1:1. We make it as a break-even trade. And after that, if you get the opportunity to trail onto it, we start using our trailing stop loss. And that is how we plan trades in a very mechanical and rule-based way. Now, before the session ends, what I also do is, at the end of the session, I take your questions queries. So whatever questions queries you have, you can start putting it into the chat box. I'll try to answer as many as I can. But I would also like to add that, in fact, before adding, something which I would like to update you with, I also would like to request that if these sessions are helping you, then do like the video, share it with your friends, family members who are into trading. And if you're on some trading group, you can also share there. You can share the link to my courses. You can share the link to these live sessions. You can share the link to the trial of the demand and supply zone indicator so that more and more people can take advantage of it. Now, coming back to, like I was saying, that you can definitely put your questions in the chat box, but I have been getting this feedback that in the chat box, you can't share your analysis. So in case you want to share your analysis, or at times you're not comfortable sharing your queries in a public platform, right? So you want to have a one-on-one session. So in that case, we do have that option now. So on our website on the top, you'll be able to find this one-on-one button. So you can click on it and you can schedule a one-on-one appointment with me. There are two options available. One is a telephonic conversation. If you feel that you can ask your question on the phone and that would be more than sufficient, you can go for a voice call. If you feel that you want to share your screen, you want to share your analysis, then you also have the option for an online appointment. So this is where you can schedule your one-to-one appointment with me. And like I said, otherwise, you already have that option for putting your questions, queries during the live session in the chat. But yes, just in case, you want to share your analysis, or maybe you don't want to ask publicly, then this option is definitely available. All right, so let's see what do we have in the chat box. So yes, very good afternoon to all of you. And Sunil says stock name. So again, Sunil, I have been doing these sessions for over an year, and probably maybe you just recently joined. And this is again to inform you all that I purposely do not disclose the name of the symbol. And the reason for that is that these sessions are not to give you ready-made trading opportunities. I don't want to do your homework. These sessions are inclined towards you people learning how to do the analysis, because if you learn how to do the analysis, you can do it for yourself. So again, not giving the fish here, I'm teaching you how to fish. And that is why the names of the symbols are never shared. They are only shared as an example. And again, like I always say, just because I'm doing the analysis does not mean we forget about it. Whenever they get triggered, we also review them. And whenever we are reviewing, you can always match the before and the after charts. You will see they'll always be the same chart, so that even if you don't know the name of the symbol, you know that the analysis is getting done on the same symbol. All right, so that brings us to the end of today's session. Thank you everyone for joining in. I'll be seeing you next weekend. Till then, trade safe. Enjoy your Sunday. Take care. Bye-bye.